When we are traveling in a local train and suddenly it slows down while the train on the other side keeps moving fast, we get down at the next station and try to catch another train. But later we realize that the earlier train has moved ahead. Similarly, after 5 days we open our app and see whether the price has gone up or down. My belief in investing is to put blinders on like a horse. One advice I would give is delete all the apps where you have invested. Download them again only when you want to invest. After investing, uninstall them again. You'll make a lot of money in the long run.
Stop tracking.
Yes.
Welcome to Market Pillars Uncovered, an educational series where we explain investing in simple language and have in-depth conversations with the leaders who are shaping India's financial ecosystem. We are joined by Gaurab Parija, the Chief Business Officer at Bandhan AMC, a fund house with a 25-year legacy of transforming savers into disciplined long-term investors. Mr. Parija plays a key role in driving the company's growth, expanding investor reach, and strengthening its investor-first philosophy. In this episode, we will discuss the future of the Indian economy. We will understand the opportunities related to Bandhan's transportation and learn how to build the right mutual fund mix that can deliver long-term growth. Along with this, we will look at the role that gold ETFs and silver ETFs can play in portfolio strategy. We will also discuss which common investor mistakes can cause losses and which winning habits can lead you towards strong financial outcomes. Gaurab Parija, thank you so much and welcome to Money TV.
Thank you, Karunya, and thanks to Money TV.
So let's get started. First of all, we would like to know that now we have entered the second half of this decade, so looking at the next 5 years, how do you see the markets and the economy shaping up? What are the big trends and the main indicators that we should look for the next 5 years?
So, I expected this question, and my answer may sound a bit cliched, but if you look at the economic outlook, that's what people are really focusing on. Looking at it, firstly, we have to look at some very simple statistics. I think India today is very different from the India of the past, just from some data points. Firstly, India is clearly the fastest growing GDP across the world, especially when compared to other countries. India is the fourth fastest growing country in the world in terms of GDP, and we are now larger than the UK and France. India is still a relatively young country. Our per capita income is rising from about $2,500 to $3,000. India has around $700 billion in foreign exchange reserves. The major pain points India had, fiscal deficit and current account deficit, are now under control. From a layman's perspective, if you simply look around, you can clearly see this progress. Let me give you an example. Yesterday, I was at Wankhede Stadium where India was playing against the West Indies. Both countries are among the top 10 cricket-playing nations and the stadium was 95% full. When I took the train back home to Andheri at around 11:15, suddenly at Mahalakshmi, there was a huge crowd. I think around 1,000 people suddenly entered, and we were completely bewildered, wondering where all these people had come from at 11:15 at night. Then we realized that there was a John Mayer concert happening, and that clearly shows that consumerism in India is growing at a very rapid pace. Having said that, it does not mean that everything is perfect in India. India has its own set of problems, but clearly we are pushing through and addressing these challenges over the next 5 years. When it comes to investing, I think one big mistake people make is looking at a 6-month or 1-year horizon. Investing is not about 6 months or 1 year. I think most Indians have realized that we are likely to live for around 100 years, so investing is not just for 30 or 40 years. And until India becomes self-sustaining, I believe we are in a very sweet spot.
That's interesting. So in such a case, if someone is just starting out in the market and asks which themes or sectors they can invest in or closely track over the next 20 to 30 years, what would be those sectors that would be on your watch list?
Sorry, I may disappoint you. I won't give a straight answer. I don't have a crystal ball. While 2030 is only 5 years away, predicting which themes will play out over the next 5 years is very difficult. It may sound cliche, but we live in very interesting times. Whether you look at geopolitics, the economy, or climate, things are changing very rapidly. Because of this, it is very hard to predict what will happen over the next 5 years. If you are just starting out, the first point, and I know this sounds boring and like a broken record, is that you must decide why you are investing. Let me explain this with a simple analogy. If you ask me how to go from point A to point B, but I don't know where your point B is, what advice can I give you? If you say your point B is Kokilaben Hospital from where we are sitting in Andheri, I'll tell you to walk. But if you say your point B is Delhi, then walking won't work, you'll need a train or a flight. If you then say your point B is not Delhi but the United States, the mode of transportation changes again. The same analogy applies to investing. You must be clear about what you are investing for. When asked, most people say, I want to make money. That is a basic requirement. But how long you want to invest defines where you should invest. If you are investing for the long term, you need to invest in an asset class that can beat inflation over time and stay invested. My suggestion for any beginner is to first define the goal. It may sound simple and boring, but trust me, this is the hardest and most important part. Once that is done, stick to a plan. For example, 80% can be your core holding. In mutual fund terms, this could be flexi-cap, multi-cap, or funds without a market cap bias. Then build a satellite portfolio around themes. If innovation is a theme today, or transportation is a theme, you can allocate some money there. You can also keep a small portion in commodities, around 10-15%, either directly or through multi-asset funds. That is how I would suggest structuring a portfolio for someone who is just starting out.
That's interesting, but as you mentioned earlier, when you look toward 2030, you see a very strong consumption trend. People are spending more on consumption, and we are also seeing premiumization, concert culture, weekday concerts, and cricket matches running at nearly 95% capacity. So if we focus on the next 5 years, could premiumization in consumption be one major trend that plays out?
Actually, there are 4 themes in India. One is premiumization, second is digitalization, third is financialization, and fourth is retailization. These 4 themes will play out, but in what percentage they will play out is very difficult to predict. But I think broadly, most portfolios will be skewed towards these 4 themes. What proportion every fund manager, every fund house, every investors choose to buy it depends on the underlying factors at that point of time, but these are the broad 4 themes which are playing out for India. The other 2 themes which are playing out for India are very interesting. Firstly, we believe does the Japanification of the world which is happening now. What is the meaning of that? It means that the world is getting older and the world is now starting to see what we call flat to negative real rate of data. So if you look at Japan and forget what is happening in the last 6 months, last 30 years, Japan is an old economy. But Japan has lots of money. But if you are a Japanese and you go to your traditional parts of Japan, the bank would give you negative rates of return. So, Japan has been exporting capital to the rest of the world in the biggest manner. The same phenomenon is playing out across multiple regions. So, there are pools of money, but at home, businesses are not growing because people are getting old, productivity is falling, so they're investors. They will start looking at regions where we can invest and earn real rates of return. And clearly, India is ticking the right boxes. The second theme which is playing out in India is that India is by de facto becoming the office provider of the world. So what does that mean? So if you want to hire an accountant, you come to India. You want to hire a lawyer, you come to India. You want to hire an engineer, and apart from IT engineers also, you come to India. So from a professional services pool, India is now the labor capital of the world. And that's a big theme which is playing out. And like I said, until and unless we mess it up ourselves early on, I don't think India can be ignored from an investing perspective. And it also comes from the fact that India is still a relatively young country. We are an educated country, and in the end, we are providing this large pools of white-collar talent into the world. So these are the things I think will be shape up how the investment outlook or economic outlook goes.
Interesting, when you talked about portfolio building, I want to circle back to that. Let's talk about Bandhan AMC, the way trends are playing out right now. You have mentioned several funds and different types of funds as well. So, what is the core offering of Bandhan AMC? In such a scenario, the way the macro is playing out, of course, there are fund options as well. What are your core offerings? What are your approach to investing?
So over the years, not only Bandhan but most fund branches have realized that typically, when you look at investing, we see that there is growth and there is value. But the way the market is shaping up now, I think if an investor says that I will only focus on growth and not look at value, then you will get stuck. So the philosophy at Bandhan is that investors should be style agnostic, meaning they should be able to move flexibly between growth, quality, value, and momentum. Secondly, you should not be biased toward any one market cap category. You shouldn't say you will invest only in large caps and ignore mid and small cap stocks. I've been advocating flat out that if you are to look at the three segments of stocks, one is large cap, then mid cap, and small cap. Very interestingly, the first 100 companies in India are considered large cap, from 100 to 250 are considered mid cap, and beyond 251 are small cap. And there is a bit of a mismatch. We've been advocating of late that if you look at the three segments of stocks, one is large cap, one is mid cap, and one is small cap. Very interestingly, the first 100 companies in India are considered large cap, then from 100 to 250, and there is a myth and misunderstanding or apprehensions that small caps are highly volatile stocks. But THW way we are approaching the whole investment, this is we believe that if you want to generate alpha over the next 5, 10, or 15 years, and if India has to reach the $8 trillion mark and Amritkal, then clearly, just 200 or 250 companies are not going to take India to that level. So, you need 1,000 or 1,500 companies, and the approach should be, can we identify 300 to 400 companies in the bucket which is beyond 251 to 2,000? And if you read the papers, every day there are 3 IPOs coming up and you have to find them. Now, to find them, you need to research them. To research them, you need analysts. So one of the things we've been doing is beating up our analyst team, and today as we speak, we analyze 700 companies, and out of those 700 companies, we think we should be able to give 400 to 450 ideas which will give you the alpha. We are not saying for a moment that large cap stocks are bad. What we are saying is that, in the current environment, large caps have not been able to beat nominal rates of return because they have already grown very big. If India is growing at a nominal rate of 9%, how can we expect one of the top 100 companies to grow at 50% because they are so embedded to what India does? And that's where you will have to be a little bit more flexible in your investment approach. Don't get married to one cap or one style.
So, this agility code, do you think that is the edge that Bandhan AMC brings to the table? Because there are many AMCs in the market, so what do you think that edge is?
The edge is the dynamic approach. I think actually our fund, the large and mid-cap fund, its starting philosophy itself is called DAM, and the D in DAM stands for dynamic, we believe. The traditional ways of investing approach are quite outdated and historical. You have to keep up with the times and keep shifting accordingly.
You know, since we were talking about themes, you have a fund, Bandhan Transportation and Logistics. That is one theme you have been tracking very closely and which has also performed quite well. So is this an industry trend, or does Bandhan MF have some special secret sauce? How did you identify these companies and this theme?
While I would like to take credit, people often say we have a secret sauce, but in reality, there is no secret sauce. I may sound biased when I say this, but if you look at our entire fund basket over the last 2 to 3 years, our equity platform has become very stable. Nearly 70-80% of our funds are in quartile 1 and quartile 2. But it's not that we did something very different specifically in transportation. What really helped was that we had a very strong fund manager who has been closely tracking the sector. For a long time, ever since we launched, keeping in mind that this was our area of expertise. But if you look at our other funds as well, I think we have done very well given our overall approach to investing and our ability to research more stocks. That is helping us create a more stable client experience across the fund platform. Transportation and logistics is clearly one of our better funds, and we are fairly proud of it.
Interesting, the performance speaks for itself. If someone is starting out in the market today, tracking if they want to proceed with discipline and a long-term approach, then what kind or type of funds should they definitely include in their portfolio, according to you?
Before I think, when we talk about which fund to take, I think there are three things I would like to point out. Firstly, there is a very interesting quote by George Soros who says that if you find investing exciting, you are in the wrong class. The first thing we need to understand as investors is that investing should be boring, which means you don't check it every day. So, if you are into gardening, you don't look at your plant every day expecting it to grow. Same thing here. Just focus on, like I said, what is your goal? What is your need? Start with a little bit, broad category funds or multi-cap, flexi-cap, multi-asset funds and all of that, which would help you build a core portfolio. The second thing, we see classic investment mistakes where people tend to buy everything. So, 5 people, why 5? Stick to 5 to 6 broad categories. Otherwise, in the investment universe of 1,000 stocks, if you take 6 flexi-cap funds and all 6 have Infosys, then you are not really diversified. You have just diversified by name, A, B, C, D, but not by stock. So, your core holding should be 75% and the rest could be 25 to 30%. But the other thing people should also remember is that if you want to create wealth, you should focus on what you know best and let the person who knows best how to manage your money be your friend in need. So, I think people should also look at this: do I have the expertise, the time, and the competence to manage my portfolio, or do I need to move to an FD registered advisor to manage that? So that's the other thing is, people, just to save that 50 cents or 60 cents, tend to do. I think those are the other two things you have to keep in mind. But again, coming back to the same answer, what are you investing for? What is your goal? And is the fund suitable? The good part is, mutual funds offer you pretty much a fund for one night, overnight, to a fund for 40 years, so there is the whole range of funds for you.
Based on the goal, the other parameters you mentioned.
Absolutely.
I want to toss in one more product and one more vehicle into the mix, which is ETFs, especially silver and gold, the flavor of the year. If I may say so, I think the way gold and silver have performed, even in ETFs, subsequently, it has been phenomenal, hasn't it? Tell us, this demand that is there, are you still witnessing a surge in demand among the investors and clients of Bandhan AMC? Are you still seeing this momentum in gold and silver ETFs? And secondly, from your perspective, how does the future look for this in the medium term? Because for those who are thinking, should I miss, buy, or choose at this point, or what should they do? So there are 3 parts to it. Firstly, I think I also admit that if you were to ask me the question 10 years ago, should you not invest in gold and silver because they are just hedge products and not return-generating product categories? That would be hopelessly wrong. They have clearly been return-generating asset classes, and I think it needs to be part of your portfolio to the extent that, again, depending on your own risk profile and cash flows, but as per estimates, between 10 to 15%. Second is the interest in this. Interest can be misunderstood in 2 ways. One is interest on a sustainable basis and interest on a recent basis. Clearly, you should understand the investment concept. There is something called recency bias. Due to recency bias, people are running after everything or want to bring it in. Clearly, that's coming into play. I think people, the whole FOMO concept is at play. Everyone is saying, my neighbor has bought silver and it's now 5 times up, so I should also jump in.
I don't think that's how it works, but if you ask me about the next 5 to 10 years, I think gold, silver, and other metals will clearly come into their own as asset classes against inflation. Depending on your needs and your ability to manage, because please understand, the volatility will be there, especially in silver, which is a high beta asset class, and it is high beta because not only is it a precious metal, but it also has industrial uses. Depending on how economic cycles move, one of the parameters will be affected. So, gold would be a little more stable, but as gold becomes so expensive, people move to the next metal, which is silver. Now, people are even extending this to copper and platinum. I think whether it will be sustainable or not, and whether it will see its good days over the next 5 years. I think if it does, all of us will become Warren Buffett. It's not going to happen that you'll get 100% returns every year. There will be times when the prices stay flat, if not come down. You have to be prepared for that, but it's a nice commodity to own, but don't overdo it. Like with every other asset class, don't go overboard just because it has done well in the recent past.
You just talked about FOMO and recent bias. So, what is the one mistake that retail investors make or repeat the most?
So, if I do take the analogy of Mumbai local trains again, typically, when I am on my way back home and traveling in a local train, sometimes the train suddenly slows down while the train on the adjacent track keeps moving fast. So, at the next station, we get down and try to catch the other train, but then our original train moves ahead. So I think one of the mistakes which I see people making is that they keep checking what their neighbor is doing or keep looking outside the window. My simple belief in investing is to put on blinkers like a horse, stay invested, stay on track, and clearly understand that if you are, let's say, looking at equities, equities are not a short-term race, it's a long-term game. It's not that you just buy a fund and exit immediately, but give it a proper course of time. Second, I think every investor needs to realize what is my risk potential, what is my risk appetite. Now, everyone believes, no, my risk appetite is for 5 years, but after just 5 days, we open our app to check whether the price has gone up or down. So I think there is a big misunderstanding between what you think your risk appetite is and what it actually is. What your risk appetite is. Third big mistake people make is overconfidence, right? Overconfidence, very simply saying, in the end, I've invested in equity, in small cap. Now, what is the best for me? Let me double my investment in small cap. But the stock market is unforgiving. The market is king, and the market takes care of these cycles. So these are some of the nuances investors need to be watching out for and like. As I said, I think you just have to be very patient, look at your end goal, and focus on what you keep doing. I keep telling clients, whether you are a doctor, an anchor like you, or an architect, that if you focus on your own work, the chances of multiplying your wealth are significantly higher rather than dabbling in these funds on a daily basis or in stocks on a daily basis. You can do it, but then please quit your current profession and become a full-time investor. Don't say you'll be a master of all trades, and that's where people make a lot of mistakes.
So, what is that one absolutely important and winning habit that every retail investor must adopt?
I think the habit is, please delete all the investment apps from your phone. I think we tend to get fixated on a daily basis, if not on an hourly basis. Just for me, a little bit of reflection and disturbance, a flashback to 30 years ago when I joined the industry. At that time, if you invested, you used to get certificates, and those certificates would come to you after a month. And by chance, if you lost those certificates, first you had to go to the police station and then give a report to the mutual fund house, who would then reissue it. That process would take another month, and there was no claim for that certificate during that time. Then, after 3 months, you would get a duplicate. Because of this, when it came to certificates, 99% of the people would put them in the locker, and whatever valuables went into the locker, including those certificates, would just stay there for years. And after 10 years, you would pull out the certificate, and on average, the managed fund would also have given a decent return. The problem was that because that certificate was in your locker, we tended to treat it like early visibility, which for me is the biggest thing. So, if I had to give one piece of advice, it would be just delete all these apps you use for investing. Download them only when you actually want to invest and uninstall them after that. You'll make a lot of money in the long run.
Stop tracking.
Absolutely.
All right. But just now you mentioned that you have been in the industry for over 30 years and you have also had a long and transformational association with Bandhan. You have seen them through. You have seen various phases. So according to you, what has been your biggest learning about the industry and about investor behavior? Is there any milestone that you would like to recall?
So, 30 years back when I joined the industry size was just 1,000 crore. In 30 years, the industry has grown 100 times. So if you were to take the industry as a stock, the stock has done exceptionally well. We talk about 100 baggers in stocks, but this industry itself has been a 100 bagger. Now, if I flash back to 30 years ago and someone had asked me to predict where the industry would be in 2026, I don't think I would have put a number like 20 lakh or 25 lakh crore. The industry is clearly just bulldozing its way ahead. I am very proud to be part of the industry right from pretty much its inception in 1995. What have been some of the learnings in this industry is fund houses never have it good all the time. There will be phases when your performance will be tested, clients will not be keen on investing with you. You have to stay the course, be patient, and be very persistent in what you do. I think the industry also rewards fund houses which do a lot, a lot of emphasis is placed on training the internal staff and the partners they work with, and on giving ideas about how my distribution segment can grow. Because fund performance is always cyclical, sometimes you're doing well, sometimes you're not, and every fund is the same. Especially after categorization, there will be large cap, mid cap, small cap funds, and so on. Again, there will be mid cap, small cap, innovation funds, and so forth. So how do you differentiate yourself? So, one of the things, at least in my opinion or my experience, is that this business is all about knowledge and skill, isn't it? How do you constantly progress your knowledge and skills, both from internal stakeholders and externally? Secondly, this business is also about activating new clients. We always say it's 3 lakh crore, but even now, we are only 15% of the GDP in terms of mutual funds, just a tiny 15%. So, there's a long way to go. I think that's the other thing. We keep trying with our partners to figure out how to keep acquiring new clients through multiple events, investor awareness programs, and all that. Along with mutual fund Sahi Hai, this is a journey we want to continue, and that has been a big learning and differentiator for us.
Great. So let's talk beyond the market as well. When you're not investing, tracking markets, or handling work-related matters. So what do you do in your free time? Any hobbies or interests that you follow?
One is, obviously, you do a little bit of non-financial reading, so that's something I have picked up, be it on psychology or philosophy and all of that. I don't look like it, but I used to be a very active sports person, but now I'm a very big passive sports person. So, one of the hobbies is trying to catch up on most live events, so I've been fortunate, the classic final, the 2023 World Cup between Argentina and France, lucky to see Messi at his glorious best, lucky enough to see the World Cup cricket finals, and the same is, so I have watched all that pretty much in Bombay, the IPL, Hockey League, Badminton League, I've seen all of them, and I take my daughter along with me, so that's clearly a hobby for me. And again, after traveling for 3 days a week, you just want to unwind over the weekend and not try to pack in another hobby. I think that I will pick up more hobbies as and when I quit this job and get some free time. And traveling has been a passion. The way we approach traveling is, You just pick one country and go deep. So, let's say we go to Italy, we just spend 2 full weeks in Italy rather than going city by city or night by night. And that's the way we generally travel in most countries. I think driving on your own gives you the opportunity to stop by the side of the road, look at something, and not be in a hurry to catch a bus or anything like that. That's what I do in my free time.
Great, that's wonderful. It was really nice talking to you. I completely agree with you. Thank you so much once again for giving us your time and joining us.
Thank you. Thank you once again, and thank you to everyone. I think those were very insightful questions. Some of them were quite tricky as well.
Thank you.
Thank you.
That brings us to the end of today's Market Pillars Uncovered. For more such insightful conversations, don't forget to like, share, and subscribe to Money TV. Because here, we have direct and meaningful discussions with market experts. We'll meet again in the next episode. Till then, invest smartly and stay informed.